Let's
So
do
let
that.
me, yep, I started
Okay.
recording it. Yep.
Yep.
Okay, great. So first I'm going to introduce uh, Naila Sharma and Deepali Sharma, married couple who were former students of mine, and they went on to greater things. They achieved the CPA. They both went to one of the big firms, EY and KPMG in the case of Deepali. And now they're working outside of those firms, but they are practicing CPAs. Oh, cool. We got Henry Hutchings coming. Okay.
Yes.
Just as we start, people are going to
Yeah, I
start
know.
pouring in.
I'm going to end up introducing you like 20 times, right?
Yeah, it
Okay.
seems
Mhm.
like it.
Can you hear me, Henry?
Yes, I can.
Okay, great. We just started and we're gonna go ahead and start. And I just introduced my two former students who were happy to join us tonight, Nilesh and Deepali Sharma. They're both CPAs and they've practiced with the big firms and now are doing their own thing outside of those firms. Deepali, are you still with KPMG
Oh
actually?
yeah, I am
Oh, you
still
are.
with the
So
phone. Yeah.
excuse me, she's Deepali's still at KPMG. Nilesh is with a private company. Um, so I am not a CPA, but I'll tell you a little bit about my story, and that is that I got into Cal in the high school, and I was really thrilled as a young guy, thinking, "Oh, I got into this great program, so I'm going to concentrate on finance." And like anyone who's ambitious at that age and eager, and I said, I'm gonna know everything there is to know about finance. I'm gonna be a real super expert. And when I got into us, I remember thinking to myself, gee, I really only took one accounting course. And so then I was surprised through the MBA program. I only took maybe two more. And I really knew at the end of that program. I was really pleased to get out of it and everything, but to graduate. But I said to myself, I don't think I'm an expert in accounting, and I don't think I'm an expert in you know in reading financial statements. So I decided I'd take a program, and not the CPA one, but the CMA. So I was a CMA. I'm just retired from it now, but so I was a certified management accountant, and it helped me really understand accounting much better. It was a terrific program to go through, and but still at the end, when I looked at companies, and my aim was to be in either a treasury department or as a financial analyst, with an investment firm. Um, and I still knew, boy, I really don't know a lot. I mean, I know a lot about accounting now, but that doesn't mean you can just read over these statements and walk away and say like, gee, I'm going to go tell someone to put their life savings in this company or that company. So I still felt a little bit uneasy about financial statements. So I continued to work through it. And I went through the CFA program because that's the sort of work I wanted to do. And even there, so now I've done like a CMA, a CFA, an MBA. So you think, I'd be entirely competent, but uh, I wasn't so confident about it. And I think looking back that was great. I'm glad I wasn't because uh, it really just takes a lot of work to understand where the value is in a company. And the financial statements are invaluable. And people often ask me, do you think there'll be CFAs in the future? Do you think there'll be CPAs in the future? Maybe we'll all be replaced just by with a software program or something. But I think most definitely there will be, even with the AI thing, uh, there's going to be. And the key thing is that it just takes a lot of work to really understand the value in a financial statement. So let me share what I did. I'm going to check one thing. I just came, and this is strictly a health issue for me. Oh, I'm doing fine. Okay. I got a monitor that tells me if I need to, take sugar or anything like that. So anyway, you can edit that out, Acme. Okay, here we go. So I'm going to share this, and I hope that you can also put our faces like on the side when you're watching this so we can talk to each other, because especially since it's such a small group,
Mm-hmm.
I want to make it as interactive as possible, and I want to make sure I invite everyone to talk, and don't anyone think that there is a stupid question. There's questions that might be impertinent if they don't pertain to the matter, but there's no such thing as a stupid question. Any question is welcome. And I tell you, even, I was telling you how uncertain I felt earlier in my career about financial statements. And so there are many times where I just said, gee, I thought I should know this stuff better, and I don't. So, ask away now if you have any questions about this. But so I could call this like just some thoughts about financial statements, but I don't know. I was just throwing stuff together. I said the real essence that we're going to talk about is intangibles, and that means intangible assets. Okay. So to you guys watching, and to all other Berkeley students, you guys are full of intangible assets yourself. That's what it's all about. Most of you are going to have really good careers, and that's because you got drive, and you got intelligence, and you got all those things, and you can't put a price on them. And but they're the most important thing. And companies, this is what companies have too. And so how do we find value when that becomes one of the major assets? Okay, so let me see the best way to flip this thing. Okay. Wow, can you guys read this, or is it are the margins too messy?
It's legible.
Yeah, it's good. Yeah.
Okay. All right. So I've got to go really quick here. This is not something that happened yesterday or last year. And the history I'm going to give you kind of it's the time frame that I started paying attention. I was a student in 1980, early 80s in Berkeley. But the first thing mentioned here is that there's always been intelligent criticism of financial statements. And one of the key articles that came out in 1974 was by Joel Stern, and it was, I can't even see let's see here. Sorry okay. The essence of this article was that the income statement, which gives us earnings, ends with earnings, net income, right? That's and the nickname for it is the bottom line, right? So you have everyone saying, what's the bottom line on this country, on this company? What's the bottom line? Tell me the bottom. That was the original bottom line, net income. And this analyst came out with an important article, and he said, our earnings number doesn't seem to tell us anything anymore. And he said the best thing to do, the reason for this is because we have things like, we have these rules that we put in there trying to make it better, but we have so many of these rules that are trying to make it better that it just confuses the issue. Some of those rules in this time especially would be that you accelerate depreciation. So someone in early 70s or something may own apartment houses, and they're accelerating depreciation on that, given the rules. And they want to do so because that lowers their net income. And when they do it for tax purposes, it lowers their tax payment. In any case, that's one example of just an arbitrary rule. But you and I know that the apartment houses, so to speak, or whatever they were, generally went up hugely in value over those years. So it really didn't tell you how well this person was doing. That person's income statement, which showed a lot of accelerated depreciation, meaning that the building's becoming worth less, was not a good representation of what was happening. That person probably got wealthy by owning the apartments. Anyway, so Stern said, let's go to free cash flow, in which case depreciation and other things would not be put in there because it's really not a cash flow. And so that was one step. That was an early step. And just as an aside here, so I'm asking a question. Why was this important? I just described why it was. Is it still important? It still is important because even though everyone from a business school understands that free cash flow is an important measure, you'll see that each and every quarter, the financial press is always screaming about, let's look at the earnings. What are the earnings? What are the earnings of this company? What are the earnings of that company? Oh my gosh, we got to, sell, we got to buy because the earnings are a little bit low or a little bit high. So they're still central to financial analysis. Just as an aside here, there's a guy, Martin Fridson. He's a really good commentator. And he happened to write an article about this, and it was published in last year's. It was the 50th anniversary. And he said that article, the original article, was so important that he wanted to talk about it 50 years later. And I put a recommendation there. He said you should follow Marty Fridson. Fridson is a really good commentator. He's worth following or connecting with on LinkedIn. Go ahead and be bold and connect with him. Then came when I mentioned this CMA program, and that really helped me a lot. And at that time, these books were new that came out of there, and they were important books too. This one called Relevance Lost: The Rise and Fall of Management Accounting. So this was an important book by also a guy who's still with us. Also, his name is Robert S. Kaplan. I'm not sure about Thomas Johnson, his co-author, but Kaplan is a very big consultant and a very accomplished consultant. He's out of Harvard Business School, but he's had a long career now. I mean, he's got to be late 80s or something, but he addressed this issue, the lack of relevance with financial statements, by creating what he calls the balanced scorecard. And if you wiki that or just Google it, you'll see that it's a very significant tool in the business world. And it's worth reading about if you're getting into this issue of the relevance of financial statements and how we find value in a company. His point was that the loss of relevance was largely due to an overemphasis on external reporting and a lack of adaptation to the changing business environment. This is all, by 1991, a long time ago now. So let's jump forward now to close to these days. And here's the funny thing: when Acme, when you came to me and said, we want to give a talk. And I said to myself, in my mind, I'm saying, oh, I know what I can talk about. I can talk about Baruch Lev and Feng Gu and their work from like 8 or 7 years ago. And this was a terrific book. But the funny thing about it is that when I started preparing, I realized the CFA Institute had just done a research paper, research item to update, what's going on with this because Levengood made this argument and they made many proposals and they said, here's what we should do. That's what I was going to talk about uh, today. And I found that the CFA Institute just published something and it's available to all of you too. And so, there's a link for that here too. So here's a book and then a later article by them. What was their key findings? One is that gap, and I know you guys or some people watching this are going to wonder what I mean by gap, but that is generally accepted accounting principles. So you're looking at Nilesh and Deepali here. They went through the CPA world, and this is like the code of honor for them. They have to make sure that things are in line with the generally accepted accounting principles when they're auditing a company, right? They have to really know uh, how to apply these principles. That is what a wonderful idea GAP was. Okay, I'm half ironic, but it is the good thing about GAP is it gives us something to keep people honest from different companies, right? You're looking at different companies. If it's GAP accounting, then that means it's generally approved accounting principles so that you can compare things. It's incredible. You compare things across time, you can compare things across companies. So that's a great thing. On the other hand, this is a code and it's turned out to be a rather rigid code. It does change, uh, uh, you know, at times, but to make drastic changes is quite different. And sometimes drastic changes are called for. So that's kind of the theme here. Conventional earnings-based security analysis lost much of its usefulness for investors over the years. This is one of the key findings of Levengood. They back tested the usefulness of this earnings per share. Once again, that's net income. Earnings per share, by the way, is another way of saying net income. You're just putting it up against the share. So net income or earnings are the same thing. And when they back tested the usefulness, they found that even if they had some magic crystal ball that gave them the perfect earnings number, they still wouldn't have an advantage as an investor. That's a really damning back test, but that's the thing they did. And what's that saying is that the earnings number is there's so many things like the accumulated depreciation, or rather accelerated depreciation, or other adjustments and accruals that uh, that it throws it off and it just doesn't give it a good. It's not a good number for predicting the value change in a company, and that's a very important. That's what investors want to know. So the implication here is that winning investors, people who are beating the market, are using metrics other than EPS to discover value. Okay, so what to do? Uh, we need to refocus. This is from Levengood. Refocus to the evaluation of an enterprise's competitive advantage through an analysis of their operating strategic assets and their use. You need to identify strategic assets. For example, a pharma company, it may be their drug pipeline. Or for a software company or something like Netflix, of course, you've got their subscriber list. And the nature of the subscriber list and the amount of paid subscribers. For a natural resource firm, it may be their properties, both active properties and properties that are inactive, sitting on the and valued at a historical price, which is out of date. And then you got to assess the quality of such assets. So I want to take 1 second to stop here because I used to love bringing this up with any finance or accounting course, that there's really two things always to think about: quantitative and qualitative characteristics, right? So we get seduced by the ability to make quantitative judgments, especially when someone gives us rules. Then we can make quantitative judgments and we start believing that this is what it's all about. But we always have to ask, what is the qualitative nature of an asset or a liability? And so that's what the conclusion is here, that what's needed is assessing the quality of such assets. And that means non-GAAP info, because GAAP just doesn't cover it at times. You have to have non-GAAP info. So now we have a little bit of a problem here, because non-GAAP info is something we want. But on the other hand, if we have non-GAAP info, we're going to trade off consistency and the ability to compare. So, and there may be disadvantages like the ability of management to manage or manipulate metrics, and the lack of a historic reference to them as well. Okay, so let's move on. So this then comes the CFA Research Institute survey, just came out this February. And so they went and they asked experts, what do you think of what we need to do? And what do you think of the state of current affairs? And this built on Levin Gu's work. And here's the link to it, but we're going to talk about it now, the key findings that they had. So before I go into that next slide, I really probably should have put this in one of these early slides. But the essence of the problem here, I mentioned before, it's getting a good sense of the value, which is, quantitative and qualitative value of the net assets of a company. The really difficult thing that has hamstrung the accounting world and in the financial analysis world or investing world is that it's a marvelous thing that the really valuable are more and more assets of the mind, really, assets of knowledge, assets of information. So these are intangible assets. And so in the past, if you were analyzing a company, or if you're accounting for a company that had several factories with several machines, and they're competing against other people in the industry, quite easy to put a price tag, put a value on those machines, that plant and machine, and the level of the amount of people that you hire, that you're hiring for labor, and you get a good indication of that. But that's not the case these days when you have companies that are dealing with software and services. These are much, much harder. They're intangible assets. So let's move on and just take a look. From 1979, here are the top 10 largest firms. And I'm just counting down the energy I see there in 1979. 1, 2, 3, 4, 5, 6, 7. And 79 was not an off year there. I mean, the energy crisis and the big energy prices came in the early 70s or mid 70s. So here's a case where you have dominated by General Electric is industrial, and then you have Seven Energies, and then AT&T and IBM. So then you look down at 2023, they broke this down. They actually gave us 20 companies, but look what we got here compared to that. And you've got technology dominating, certainly in the US, technology, yes, globally dominating. There's only out of these 20 companies, there's only, I would think Exxon's in here, but maybe just Shell only is the only energy company. So if you're struggling to value a top company in 1979, you'd be looking a lot of the time at industrials or energy, which are pretty easy, or I won't say easy, but much more, you'd have much higher confidence in saying, that Chevron is worth this much because you've got a price out there of oil, and then you have knowledge of quantitatively how much oil they have and what their plants are like and such. Whereas with NVIDIA or ASML, well, I wouldn't even, I'll leave ASML out right now, but NVIDIA or even Apple, it's much more difficult to get an understanding of how their current uh, chips and the quality of such, just how they are. And but worse than that, not only is it more difficult, but the financial rules are such that these things are not going to be priced on, sometimes not even listed as an asset, but it's a huge asset. The most extreme, or one of the most extreme examples is Apple. And we're gonna go into why on that. Before we go into the why, let's just look at it again. So here's how things have changed in a generation. And then here, just 10 years, it's gone, technology, consumer, and healthcare has gone from 50% to 49% to 60% as far as sector weight. That's only 10 years. That's a really short time for such a wide move on that. And so I need to bring in one more concept, and that is the book value of a company. And the book value is their listing of assets, the balance sheet for those watching who in the future who haven't taken an accounting course, but a balance sheet basically tells you assets, what you own, and then on the other side, liabilities, what you owe. And then hopefully there's something left over. That's essentially the book value, what it's worth. In the past, uh, stocks would often trade close to their book value, or maybe in the 1 to 2 area of their book value, one to two times the book value. But if we look at some of these major companies today, their book value is only a small fraction, nowhere near, the 100% or 80 or 90% that you'd expect. So we got Visa for the US ones, just looking at the US, Visa, my goodness, that's, probably 10%. Microsoft, probably 10%. When I say 10%, that means their book value, what a balance sheet would suggest it's worth, is only 10% of what people are really paying for it. Investors are paying for it. And most of the time, the investors are pretty happy. So the value has become unhinged from the balance sheet book value. That's the key message here. Now, here's something, we were looking at some top firms there, but here's the whole S&P 500 from 1980 to, let's see, to first quarter 2024. So whereas in 1980, this large sample of 500 big companies was trading near one of their book value, near 100% of their book value. They're now trading closer to 500%, over four anyway, closer to between 4 and 5. That's an amazing change because this is a metric that you wouldn't expect would change with time. That if accounting was still as relevant and as good as measuring value, you would expect that it would be much closer to one. Okay. So what's causing this then? Okay. So I already mentioned that it's basically these wonderful but bedeviling intangible assets that are the most exciting assets in our world these days. And the accounting profession has several underlying principles. Now, here's where Nilesh and Deepali, please step in if you want to, but consistency and conservatism are among them, as I recall. And conservatism is key as a guard against aggressive accounting. It guards against earnings management manipulation, and it guards against outright fraud. So you've got to have a conservative approach to how you value something. You can't take a manager's word that when they say like, gee, I did this software program and it's worth $10 million, and I want you to sign your name as an auditor to a balance sheet that says that. You say, no way, you got to have proof. And then consistency is the other thing, that you don't want to be changing your method of how you value things easily because people are trying to compare, compare your company over different periods of time to itself and also to other peers within the industry. But both these, however great these principles are, and they are, I mean, there's very thoughtful wisdom in these principles. But both these principles have unfortunately contributed to a lack of judicious, that means sensible or sound, innovation or adaptation to the rise of strategic intangible assets. And let me go into why. A second issue. So you got that issue. Then you got when an intangible is recognized, and I add here by way of acquisition. It's a big problem here because the only way you get an intangible recognized is by way of acquisition. And managers do their best to specify what that is. So let's take an example. You buy, Netflix buys another company in its business, and they pay, $1 billion, and they say 250 million of that is because this company has a customer list. And another like 600 is because this company has different procedures that are going to help us and bring value to our company. And so that's it. So we got 600 and 250. Well, I made this for myself, and I thought this is off the top of my head. But I believe they would be able to identify the 600 and say this is, procedures that we can identify as beneficial. But the customer list, I don't think now, Nilesh and Deepali, I don't know if you know, but they're very specific about. You guys are really specific about what can and cannot be identified as an asset. And I think that customer lists I think they can now. I think they can.
Yes.
Yeah,
Nowadays, it's easy to put your customers on your balance sheet,
right,
especially if you are in service industry, where so for someone like a bank, your customer listing makes a lot more weightage because usually big companies they would want to be loyal to their financial services organization or financial institutions
right.
rather than someone, let's say, a fast food restaurant. It doesn't really matter. Like, the customer base is
That's
not
right.
going to
Yeah,
be that loyal, whatever is
right, right.
closer.
So you get, yeah, this customer loyalty is really what we're looking at here. Uh, so thank you. So now you've got two assets identified your um, on your balance sheet, and they're worth 600 and they're worth 250. So that gives you 850. But then you had this 150. So you put it into a sort of mystery account that we call goodwill, goodwill. And there's some sense to that because many companies have, they just have a great reputation. They have a name and such. And but but the truth of the matter is, in practice, in the world out there, that many times a company will pay huge amounts and they can't identify these intangibles. They just know the other company's making money, and so it just becomes goodwill. So you have, someone that shows you as a banker or investor, they say, "Here's what I have," and it says, I have $1 billion worth of goodwill, and I owe people $900 million. And you're thinking like, what the heck? Do I want to get in? Why do I want to go with this company or something? It's a very nebulous asset to say the least. And then the other thing is sometimes they do and sometimes they don't amortize goodwill into the income statement. When you amortize something, it means you put it as an expense in part over time into the income statement, just like depreciation. So there's a judgment there with goodwill assets. You have to judge, do they have a definite life? Do these things have a definite life or are they going to go on forever? You don't amortize them if they go on forever, and you do if they have a definite life. This all sort of makes sense, but the reality is it muddies things up with respect to really understanding the value of a company from year to year. And it gives management a lot of opportunity to manage their earnings again. Once again, that bottom line, net income, earnings per share, that's the thing that can be fooled around with by management, and you don't want that.
Yep.
So,
John, just
yeah.
wanted to show something to tie like your previous slide and this, because you noted Microsoft being one of the biggest companies last year, like a couple of years back,
Mhm.
and Goodwill. Just want to share my screen real quick if it's okay,
Yeah.
and show something about both of those things.
Yeah.
Because when you were talking, I quickly pulled out balance sheet for Microsoft. You guys can see my screen now?
I can't
Not,
see yet.
Not
I
yet?
didn't see that.
Is it sharing? How about now?
Yeah,
How about now?
we got
Now
it.
you can? Okay.
Yep.
So really quickly, just wanted to show this. Because John, this is Microsoft's financial. I wanted to show it side by side, but my screen is too small. Uh, this is Microsoft's financial back from like 2000, 2001. And these are like just focus on assets for now. You can see the company was like book value, let's say total assets being the book value, they were like 60 billion in assets. Do you see something missing here? The goodwill and intangibles that we
Yeah,
were
no
just talking
goodwill.
about. No
Right.
goodwill, no intangible. This is about 25 years back. And the balance sheet literally has nothing. And now let me switch over to the other side. This is from last year. So 24. Do you see
Uh,
something major? popping out
Oh yeah, they
on the
got
balance sheet.
the 119.
Yep. And so their balance sheet is roughly about 30% made, or like 25% made out of intangibles and goodwill.
The
But
25%. Okay, so that's
yeah,
huge. Yeah,
yeah.
thanks for bringing that up. That's huge. And I got a little thing we're gonna look at Apple too later in a very
Yeah.
abbreviated thing.
Sorry to like just
Oh, that's
purge in,
cool.
but
That shows over time. So uh okay, and let me go back to I'll go back to mine here.
yeah, just wanted to show like what he like we are talking about is something that you can see on the financials,
Yep.
that companies have just completely moved out from not having anything on the books to having like 25% of their assets.
And what we're gonna see is the really annoying thing or confounding thing or difficult thing is that um, you don't know which companies are showing this and which are not, even if they exist. So
Yep.
here's the main point. Now this is a fasten your seatbelts, audience, because this is like a major crazy thing when you think of trying to understand value in a company. And why is this like really a big important thing? Because some people will be investing their life savings in certain companies. And if they don't understand things like this, and they think they understand the financial statements, and that's a problem. So internally generated intangibles are not recognized due to the conservative principle of accounting. Uh, why why would they do that? Because they're often difficult to delineate, things like policies and procedures that develop. Let's be thinking of Apple as we do this. They're often difficult to delineate, and they're usually not traded. You don't trade your policies and procedures, your know-how, and things like that. You can't price these in a ready market. So if the intangibles are internally generated, they're just not identified. There's zero. Apple still has zero intangible. Uh, they're such a big company that they're going to have some intangible, but essentially, virtually uh, zero, extremely low intangibles showing on their asset side. But the company itself, I would argue, is mainly valuable because it has intangible assets. They're just not showing it accounting wise. So that is a glaring example of the problem here. And so let's take a look at Apple here. So the share price is 198. The assets are 364, liabilities 308. So the book value is 56 billion, and the shares are 15 billion. So you got book value per share. So this is ridiculous when you think about it. Oops, let me go back. You got a book value per share of Apple stock of $3.07, right? And to think that some people in the past sensibly thought that that's a good measure of the value of a company, well, it's preposterous for Apple now, right? People are happy to pay in the neighborhood of 198 today. And so they have a price to book value of over 53 times. Now let's look. These Apple. Remember, the key thing here is Apple has internally generated intangibles. Therefore, they're not even showing. They're essentially showing a zero. They're ignored by the accounting world. That's crazy. Here's CRM, which is Salesforce. And they're also like a fantastic company doing great. They're investors are saying, I'll pay $247 for a share of stock. Their assets are 103. This is what they show. 103 liabilities, 42. So they're showing a book value of 61. They've got 1.1 billion shares. So their book value per share, again, that's really, the book value per share, yeah, 55. And then price to book value is 4.5 compared to, remember, Apple's was 50, close to 54. So comparing these two with these numbers, it just looks like Salesforce is a dead company and Apple's fantastically priced. CRM is priced okay, 4 times their assets. But the reason for that is just an accounting reason, which doesn't make sense because CRM has 56 billion in goodwill. So instead of growing internally, Salesforce has grown acquisition. And when you grow through acquisition, you put a price on those intangibles, and that price is your purchase price, essentially. And so they had to say, look, we paid for Tableau, like they bought Tableau. I don't know what the amount was, but I think that's one of the very big ones here. And, the Tableau was worth, let's say, 40 million to them, 40 billion, and they might have paid that. And so they would look at Tableau, which might have had only 10 billion in really tangible things, and said, we paid 30. There's 30 more here in goodwill. So they bought other companies too, and their goodwill is equal to 56 billion. That's more than half of their asset base is goodwill. So if you then use just tangible assets, Salesforce only has 5 billion. And so then you look at their book value per share. I might have made a mistake here. Wait a minute, book value
It
per
would be
share.
about $4.50.
Yeah, it should be 4.5 there. Pardon me. Yeah. So that I got to fix that. But their price to book value now is more like Apple's. If you take this out, and once again, the message there, when you see price to book value, a key message is that the investor world, the people who are willing to put up the dollars, the people who are willing to take chances on this company, they're almost ignoring what the company says it has in assets by its financial statement. They're just saying, no, you've got this intangible value and it's not showing on your assets. And that's why we're paying so much more for you when it gets up to this level. So that really ruins any sort of comparability between if someone's looking at Apple and Salesforce today saying, where should I put my technology dollars? And they'd be foolish to use the straight off book value without adjusting out the goodwill or recognizing it somehow in Apple. So it really makes for an asset value that isn't very valuable as far as a guide to investing. That's what we want to get. So how do you fix that? So here's Levengood. We're back to this once again. I already went over this slide, that you've got to find what these intangible strategic assets are, identify them as best you can, quantify them as best you can, and then apply maybe new metrics to indicate how they are, to indicate their quality. So something like with Netflix or something, that you're looking at their subscriber base, which everyone does, right? Already. So part of this is already done by any sensible person or sensible investor if you're investing big money. But you've got to really look hard in pharma at their drug pipeline, because they've been working away and investing in a long time. And every time they invest in the past, because of accounting rules, they have to expense it with their R&D. So they've been showing poor earnings relative to the things that they're getting accomplished in their pipeline. I'm speaking about a company that's doing pretty good. In other words, one that is building a good pipeline. You're expensing this, and you're not able to. You have to show it as a loss when it's really an asset for the future. It should be capitalized, to put it in terms of accounting. And so these are the things that really have to be focused on now, because more and more, this is where the value is in companies. And you're going to, we have to, his suggestions are to identify key strategic assets and then assess the quality, more non-GAAP info, industry or firm specific metrics. And one of the disadvantages is that it introduces these non-GAAP, so non-rule based metrics. And whenever rules are taken off, then it does increase the chance of manipulation. Okay. Or managing to the metric. You should bring that up too, that we always have to be careful. You've heard of like teaching to the test, right? Or studying to the test. When you could be learning in a better way, but you end up just focusing on test questions. We've all done that. So the implications, the accounting industry needs to accept trade-offs between conservatism, consistency on the one hand, and relevance on the other. Audit new metrics. So bring these new metrics, if they're proven to be useful, into the audit process. Maybe make some rules for them so that everyone in that industry has to use them. But they have to live with the possibility that comparability may decrease with those new metrics. But if it increases the relevance as far as indicating the value of a company, then it's a good thing. Okay. Here's just the conclusions from the latest survey from the CFA Institute, is that they went out there and asked people, what should we do about this? There was unequivocal support for greater disclosure and better disaggregation. Really no more of this huge, massive, half a company is goodwill. You have no idea what it is, right? Of course, you can't get information through the notes, but they're saying we really got to do better on that disaggregating, finding out just what the heck these intangibles are that are creating the value. And then support existing accounting for acquired intangibles where they're recognized. Thank God they're at least recognized and acquired in acquisitions. Improvements needed to be made for impairment. So that's an issue as to when you write something down or amortize it. And support for recognizing internally generated. This to me is the crazy thing, that a company like Apple, can not show anything with respect to intangibles when clearly people are paying for their intangible assets. And then they had no clear consensus on recognition of internally generated intangibles, actually between using cost or fair value. That's another issue we haven't touched upon. And without action, financial statements risk losing relevance. But as is the case, there's little appetite for radical change, right? So one has to be careful about this. So anyway, go Bears. And so yeah, I should have opened this up before, but any what are you guys' thoughts on it, Acme and Henry and Jing? I gotta get the name right here. Jing Hong.
Yeah. So
Joshua, welcome, Joshua.
yeah, yeah. So I think like it's pretty important with to knows that the intangible asset, what roles does the intangible assets that plays around in the financial statements. And I'm curious that I think in John, your slides, there's saying that if it's analyzing for pipelines for pharma companies, that's the pipeline is important. Yes. So. Yeah, that drives into one of the projects I'm working on like past weeks. That it's about for the drug development companies. That when we are trying to do, because we are doing evaluations, that DCF is always going to be the one that's in our minds. But like, how do we understand it? That because I don't have the pharma experience, I don't really know like those type of things before starting the projects. So that's how can I understand the questions like how can I estimate for their pipelines that when we're doing predictions or
Yeah.
we're setting up the assumptions.
Yeah, cool. Great question. And there's no getting around that it takes some really active work. There's no magic place to look. And by the way, Deepali and now unless you can come in on this, but I tell you what I would do if I was trying to figure out whether to invest in a company, trying to get an idea on their pipeline. I'd of course read some research reports to see what an analyst said. But the other thing is, which is great today, is we can all get right into a listening to a earnings call report.
Hmm.
And in the earnings call report, you're going to get the thing. You're definitely going to get to that place where, or you're going to get led off probably by earnings. That's our net income, which may not be the real story. I mean, your goal is to understand the pipeline, but that is often where you get really you get into the sort of select personnel and the select analysts. They have a question session at the end. And I really like checking out the question session because, these analysts being paid big money and their reputation is on the line. And so they want to get at it, and so after the company does its show and tell thing, oftentimes you'll get very pointed questions about important assets like this. So that's one place to go for. I think it's really interesting to look at these the earnings call, the transcripts, or you can listen in. Sometimes listening in, you even understand that, you find out when you listen in that there's some tentativeness or timidness, in the answer, and it makes you, it can tell you a little something that they might not feel really confident about a certain thing.
Yeah, especially when if someone asks a question and the person talks about really big numbers and there is no specific like backing to it, that means they're just trying to divert into something different.
Yeah.
That would help. Uh, Couple of things that we can do, like I would do in your stage is where there is not a lot of insight that a company would be giving on their pipeline. And because that's something that they want to keep secret till they are really ready. They don't want others, especially if it's a pharma company. They don't want someone to just copy their details. A few things you can check is how I would go about it is first, earnings call is definitely one thing that you would want to listen to. What kind of drugs and products they are talking about. This is what we are going to be bringing into the market. This is what the impact is. And the other thing you have to keep in mind is pharmaceutical and healthcare pipelines, they are not like a year or 2 year long. They are 10 in decades in most cases because of the research that goes into it. So you can always see if there are things that had started about 10 years ago and they are talking about it now. That means that's something that's going to come into the market right now versus something that they have just started talking about, which is like in the last couple of years. It's something that they want to get into and they are still in the initial stages. So you won't give that much weightage to it in the next 5 years because again, the pipeline is big. Look at how the approval system works, right? It's not going to be like uh, they come up with a new drug today and within a couple of years they would get it approved for public use. No, there are like 10,000 different testing they have to do to make sure that the things are going in the right direction. And even then, at the last stage, they can be like, because of so and so forth, like side effects, it just doesn't ever make it to the market. So those would be like you pick the drugs they are talking about, then give weightage to it based on how long they have been talking about it. And that way you would be able to you are at the end of the day you are making an estimate, so you can only give weightage as to okay, they have been talking about this for last 10 years, it's going to come into the market now. If they're talking about it again, that has higher weightage in like the next 10 years versus something that they just started talking about which won't be hitting the market for at least 7 years,
Mm.
based on how long the pipeline usually lasts.
Good.
Yeah,
Good
I
comment.
think maybe I can add just a couple of things. I think John and Nilesh, you covered most of it, but there are a couple of other things you guys can also look at is there are notes to the financial statements. There are certain disclosures that the companies need to make, like for example, like situation Nilesh was referring to. I mean, if there are any contingent liabilities that the company is going to expect to incur in future, they are supposed to disclose that in the financials. The subsequent events, if something happened after the team had after their 5 year end, like fiscal year, and if something major had happened, like they have to disclose that in the financial statements. And the other thing is also MD&A, which is again not kind of audited, but that management disclosure analysis also has like good analysis on the company's performance and different metrics that they kind of review, which will give you some insight on the company's performance and like the forecast and all that kind of stuff.
Yeah, I'm so glad you brought that up, Deepali, because there's a long-standing, even when I was first learning accounting. I mean, good accounting professors often one of the first things they say is when you read an annual report, start from the back, meaning start from the footnotes. They're
Mhm.
often the most important.